Good morning, everyone, and a very warm welcome to this ICAS Talking Charity webinar on preparing for financial reporting changes. My name is Keith McPherson. I'm the chair of the ICAS Charities panel, but in my day job, an audit partner at Henderson Logay, specialising in the charity and not-for-profit sector. So I have the pleasure of being your host today. So 2025 is going to be a busy year for all UK charities preparing their accounts in accordance with the Charities SORP. Significant changes to reporting are coming in 2026, and it's crucial for charities to start to prepare for compliance with the revised edition of FRS 102, which is the financial reporting standard applicable in the UK and Ireland. And following with that, the anticipated new Charities SORP, which will become SORP 2026. So we're expecting the consultation on SORP 2026 in the spring, and ICAS will be running a further webinar on the 22nd of May about this, about the SORP consultation at that point. And that will be an opportunity to share your views on the proposals. And bookings for that webinar will be opened in March. However, for today's webinar, I'm delighted to welcome our speakers, Laura Anderson and Kelly Adams. So Laura is the Senior Manager for Higher Risk Cases and Quality Assurance at the Office of the Scottish Charity Regulator, but also the Joint Chair of the Charities SORP Committee, and Laura is an ICAS member. Kelly is an audit partner at RSM, and she has over 20 years experience in providing audit and assurance services to not-for-profit organisations and leads RSM's sector offering from their Edinburgh office. As well as looking after a wide portfolio of clients, she's heavily involved in delivering training and technical seminars and updates to the sectors. Kelly is also a member of the ICAS Charities panel. So just before we begin, a couple of housekeeping matters to remind you of. So you can submit questions anonymously at any time through the Q&A facility, which is accessed at the top of your screen. We'll save all your questions until the end of the webinar for a live Q&A. And also you can join the conversation today through the chat box, which is accessed at the top of your screen as well. And finally, we'll be recording the webinar and we'll make it available on demand for on-demand viewing afterwards in case you want to refer to any aspect of it. So without further ado, I'll pass you across to Laura to get into the detail of today's webinar. Thanks, Laura.
Keith, thank you so much for that introduction. That's really kind. Good morning, everyone. I'm really delighted to have an opportunity to be able to be part of this session today and to provide you with a bit more insight into what is going on with the development of the next Charities SORP. So between us, Kelly and I are going to hopefully give you a lot more information about things that you can be doing at the moment, things to look out for, things to start preparing for. Let's take a look at what I'm going to cover first of all. So I'm going to start off by setting the scene, making sure that we're all on the same page in terms of having a common shared understanding about what is going on with changes to the actual accounting framework, the accounting standards, and thinking about the implications for what that really means for the Charities SORP itself. It's probably then helpful for me to talk a little bit about the actual process of developing the Charities SORP. How does the whole thing work? How does the SORP making body work? How does the SORP committee function? What's the relationship with the Financial Reporting Council? Covering a little bit, obviously, about the timeline. That's one of the things that I know you'll all be particularly interested in. Keith's already mentioned that we're hoping to be able to start consulting in the spring. That's indeed correct. So what does more specifically that timeline look like? Then we'll come on and talk about some of the kind of key changes that we are going to be looking at in the SORP that come from the accounting standard in particular, and round off with what you can start to do to prepare for the changes. And then Kelly will come in and she'll give you a good lot of meat around the bones about some of the real technical things that are coming in. So hopefully that sounds like what you were expecting. Let's move on. So in terms of setting the scene, I think one of the important things just to remind us all of, and I realise I may be teaching my grandmother to suck eggs and for a lot of you, but let's be clear here. Accounting standards in the UK are set by the Financial Reporting Council. The SORP, the Charity SORP, the Statement of Recommended Practice, is based on those standards. Okay, so when anything changes with accounting standards, and specifically, obviously, we're talking about FRS 102 here, that being the applicable standard, as Keith mentioned, whenever something happens and changes in FRS 102, the SORP is required to maintain a consistent position with FRS 102, and therefore the SORP has to be updated and it has to change. So when the FRC conduct what they tend to call a periodic review of FRS 102, then we have to then follow, as a SORP making body, we have to follow that process quite carefully and quite closely. So the periodic review is when the FRC basically, they look at compliance with how the accounting standard is currently functioning. How well are reporting entities actually meeting the requirements? Is there something that could be done to improve the understanding about the requirements that are in place? How well is it really practically working? They also look at what's happening with international accounting developments. They have an eye to what's happening with international accounting standards and what the international accounting standards setting body are actually doing with their standards and the direction of travel there. But they also look at the operating environment for reporting entities and how that affects what organisations do, including charities, and the transactions that bodies enter into. All of that goes into what they look in the periodic review and how then they frame the resulting amendments to a standard. So as we can see here, they went through quite a lengthy process of consulting on what they called FRED 82. That's the Financial Reporting Exposure Draft 82. They did that between December 2022 and March 23. They then took a year to look at all of the feedback that they had gathered and to be able to then refine the amendments that they wanted to make to the standard, which they then published in March of last year. They published a fully updated version of FRS 102 in September of last year. So what they did in March is they simply published the amendments in a document. They basically consolidated all of those amendments into the full text of the standard and published that in September, and then published some supplementary fact sheets in late November to try and supplement what the standard actually says and what it expects in some of the really key technical areas. And we'll look at some of those technical areas later on. So the effective date of the new FRS 102 is for accounting periods starting on or after the 1st of January 2026. So that's the kind of key pivot point for us. So what does that mean in practice for charities? So as I mentioned earlier, new accounting standards mean that there has to be a change in the SORP because the SORP is required to maintain a consistent position with accounting standards. That's not a negotiable thing in the least. So SORPs are very much designed to work in tandem with standards. Okay, so now that we have a new standard, we can, and indeed therefore we must develop a new SORP. But the work that we have done as a SORP making body with the support and the advice of our SORP committee is not solely about keeping pace with accounting standards. It's also about trying to improve wherever possible. Because what we're very, very conscious of is the fact that the charity sector is a diverse sector, more so than other sectors that SORP serve. And that means that actually our role as a SORP making body and our job and how we do that job needs to be different. As it says there, the new SORP, hopefully we're working to a time frame where it'll be finalised, it'll be published later on in 2025, and I'll come on to a wee bit more detail about that time frame later on. So I mentioned earlier that, you know, the process that we've used to develop the SORP, it's probably quite a different process from the process that maybe other SORP making bodies use that are solely really about maintaining that consistent position with accounting standards. Back in 2019-20, we instigated a governance review to look at the process of the development of the charity SORP. And that was to ensure that the process was suitable and driven as I say, not just by that need to keep the SORP consistent with standards, but also to make sure that it really meets the needs of charities who are applying the SORP and indeed the people that are interested in making use of charity accounts. As a result of the governance review, we recruited a brand new SORP committee and also over 70 engagement partners to help us identify where best we could focus our efforts to improve the SORP. Those 70 engagement partners and our SORP committee helped us to identify 15 different topic areas where improvements could be made, or at least we could have a good look at those specific areas in the SORP and think about how we could make it either easier for charities to understand what was needed, or to be able to look again at the requirements and think, is that really the right thing that we're expecting people to do? We've also developed new drafting aims and principles to drive this development of the SORP, and that's to help us ensure that when we're writing the SORP, we're doing so in a way that really focuses on ease of use and ease of understanding. So making sure that the requirements are clearly, easily explained, and also that the requirements are proportionate where we've got latitude to do so. So this is not just about maintaining consistency. This is very much also about an improvement agenda that we as a SORP making body have had. And that's hopefully what you'll see when you see the consultation draft. Now, it's worthwhile, and that slide might just be a little bit small for some of you, I apologise, but it's worthwhile just reminding ourselves of the basic relationship that exists for the SORP making body, which is the 3 charity regulators in the UK, with the FRC and indeed with the SORP committee. So the SORP making body is authorised by the Financial Reporting Council to develop and publish a SORP. We as a SORP making body are accountable for our actions to the Financial Reporting Council. The authorisation that the FRC give to us as a SORP making body means that they retain quite tight control over what we can consult on in terms of an exposure draft of a SORP, and indeed what we eventually finalise and publish as a SORP. It is subject, the consultation draft and indeed the final document is subject to significant review and a very rigorous scrutiny process by the FRC. And that's part of what we're going through at this time. The SORP committee advised the SORP making body. So the SORP committee are comprised of sector financial directors, auditors, independent examiners, others with an interest in charities in the sector, including funders and academics. They provide advice to us to help us ensure that we understand the real practical challenges that some charities are experiencing, and indeed might experience if we were to change requirements. So it's worthwhile just reminding ourselves of those relationships and how the authorisation process in particular, I think, works in relation to the development of a new SORP. The timeline. Now, this will be something of particular interest, I think. We talked earlier about the fact that we are hoping to be able to consult in the spring, and indeed that's indeed what we're looking at the moment. So at the moment, the FRC are going through the process of approving and looking at the draft SORP that we've developed and the consultation materials. That will hopefully lend itself to us being able to start the 12-week consultation in possibly, I would say, late March at this stage. And that has to be a minimum of the 12-week consultation period. That's our intention at this time, to keep to that 12 weeks. That means that during the summer, we won't be having any summer holidays. We'll be busy looking at all those consultation responses and thinking about what they tell us that we need to change or maybe slightly revise in the draft SORP, again, to make it fit for purpose and helpful for everybody. We will then, once we've made amendments based on consultation feedback, we will then have to seek FRC approval again for the final version of the SORP prior to us being able to actually publish it, which we're hoping to do in October, in the autumn. So that's what the timeline looks like through 2025. Let's move on then and think about some of the key changes that are going to be coming in. So I'm going to start with thinking about some of the key changes from accounting standards. As you'll see there, one of the key things, and you've probably heard this already spoken about in other arenas, but one of the key changes that's going to be coming in is about lease accounting. Now, all leases, when FRS 102, the changes are put into place from 1/1/26, all leases will now be on the balance sheet. That's quite a marked change for many of us. Unless, of course, a recognition exemption applies, or indeed the lease arrangement that a charity has doesn't actually meet the definition of a lease as it's set out in FRS 102. Because if it doesn't meet the definition, it won't actually be within the scope of Section 20 of FRS 102. Now, the SORP making body is acutely conscious that charities are likely to have some probably some quite weird and wonderful transactions of this type. And therefore, what the SORP is seeking to do in this space is to support charities in understanding as easily as possible whether the requirements that are in FRS 102 about lease accounting actually apply at all to the arrangements that the charity has. If indeed they do, is an exemption then applicable? Now, that should support charities, hopefully only then having to look and read information in the SORP that's applicable to them and therefore necessary for them to understand. Now, given lease accounting will be new for many charities, we're very conscious that it might be quite challenging for some preparers. So the SORP has developed a new module about lease accounting, and it uses examples quite extensively throughout that module, more so than you would see in other modules of the SORP, because we think that further explanation should be helpful to help illustrate the requirements and what they mean in practice. Our view is that the more that charities and preparers of charity accounts can understand the reasoning, the rationale behind some of the requirements, and therefore those requirements make sense, the greater the likelihood of them really sticking perhaps through the trickier aspects when they actually encounter them, be that trying to understand where a lease arrangement exists or not, or indeed some of the numbers that they're going to need to then calculate when they come to measure the lease liability, for instance. The second particular big area that's coming from accounting standards in terms of change is around recognition of income. Now, it's recognition of income from contracts with customers. And the standard introduces what's called a 5-step model. This is a new model. This is going to be particularly relevant potentially for charities that sell goods and services. But significant change, I would say, isn't envisaged for those transactions for charities that I would say sell, for example, kind of donated goods for resale. That's not necessarily what we're talking about where there'll be changes. What we're talking about more significantly is where there are contractual arrangements in place, I would say. The 5-step model is fully explained in the draft SORP with material that hopefully supports charities to work their way through each step to reach the right outcome or obtain the correct information at the completion of each step to enable them to move on to the next one. So the requirements here obviously stem from FRS 102, but the SORP is there to provide guidance and support for charities in applying those requirements to the particular transactions and the arrangements that they have and that they regularly enter into. The consultation on the SORP will focus on how well preparers feel supported by the SORP in the explanation of those requirements. So we can't change the requirements that are set out in FRS 102, but what our job is to help make sure that charities can understand those and apply them to the situations that they have. Looking ahead then to the SORP consultation itself that will be coming up shortly, what can you get ready to sharpen your pencils to comment on? Let's have a think about that. So one of the key defining features, as I mentioned earlier, of the constituency that the Charity SORP serves is its diversity. That's a marked contrast really to many of the other constituencies that other SORPs exist, where the constituents are largely homogenous. But charities applying the SORP obviously range from very small charitable companies right through to multi-million-pound organisations. Some will undertake a very small number of focused activities. Others are very diverse. They deliver a very wide range of projects and activities that are constantly changing. And it's for this reason that the SORP seeks to ensure that it serves all of the charities that are applying it in the best way it can. You can imagine that that is quite actually a tall order, given that immense diversity. So where there is latitude for the SORP to decide how requirements are applied, The SORP making body obviously seek to be proportionate to minimise burden on smaller charities, but of course balancing the information needs of users of charity annual reports and accounts. Now, the SORP's developed within the limitations that FRS 102 provides. It can't work out with those. So with that in mind, the SORP making body will seek views on how well the actual requirements of the SORP are set out. So the requirements that come from standards, how well does it set those out? How well does it explain those requirements, particularly for smaller organisations? And where discretion is actually being exercised by the SORP making body to place a requirement on charities, is it doing that in a way that is fair, proportionate and balanced? Okay. The trustees' annual report is one of the most critical parts, I would say, of a charity's reporting process. It's a perennial favourite of mine to talk about because I think it's a really often overlooked opportunity for charities to tell their story in a way that can be really powerful, inspiring. It's an opportunity for charities to be very honest and very, I would say, act with a great deal of humility in a way that engenders greater public trust and confidence in their organisation. So with all of that in mind, Module 1 of the SORP that sets out the requirements for the trustees' annual report has been revised, and it's also been restructured to try and make it clearer for charities what they actually need to do. We really want to encourage charity trustees themselves to make use of that module and really engage in the preparation of the report. So Module 1 really aims to speak very directly to charity trustees to explain the requirements in a way that they can engage with and understand. I think we have to recognise that in the full requirements of the SORP, it is unlikely that all charity trustees are going to look at all modules of the SORP. But if they only look at one, I would really love it to be the one about the trustees' annual report. So we need to understand then through the process of the consultation whether there are common transactions perhaps that charities enter into where the accounting treatment in the SORP isn't sufficiently explained. Similarly, what we want to understand is where navigation of the SORP isn't quite hitting the mark. We've tried to improve navigation, bringing that into much sharper focus with the introduction of new modules, in particular, those ones on lease accounting, and also how the SORP cross-references between modules where that's relevant. Fundamentally, the process of consultation is there to help us make the SORP better and as helpful as it can be. So every contribution that you can give us in that process is valuable, will be used, will be read, will be thoughtfully considered, and is really important to us in helping us to achieve further improvement, I would say, and really high quality financial reporting by charities. The thing I want to kind of particularly reflect on, I suppose, is also around the wider context of what this is going to mean coming forward. In 2025, later on this year, annual reports and accounts for all charities in Scotland are going to be published on the Scottish Charity Register. That's coming from a change in charity law. So the reason I particularly highlight this is because quality has never been more important for charities in their financial reporting. And I would encourage every single charity to really use the opportunity that's provided, particularly with its trustees annual report, to showcase the excellent work that charities are doing. Okay, if you want more information about changes that are coming up in relation to the publication of accounts, please visit the OSCR website. There's lots more information there and there'll be lots more coming up. The final thing I'm going to leave you with before I hand over to Kelly is a few kind of hints and tips almost about things that you can do to start preparing. Kelly's going to, I'm sure, pick up on a few of these as she works her way through the second part of the presentation. But things that I think it's probably helpful to try and highlight at the moment are the fact that there are currently available resources to help you start to understand more about the changes that are coming. You don't have to wait for the draft SORP for the purposes of consultation to be published to start thinking about this a little bit more. The Financial Reporting Council in particular have some good resources available on their website that talk about some of the key changes, and they've got those recently updated fact sheets that I referred to earlier. Think, I would say, also about getting some support or some advice if you need to understand what these new arrangements mean in practice for your charity. That could be particularly relevant perhaps where you've got arrangements that have been in place for a long period of time and the paperwork that your charity's now got might be a little bit sketchy. Think about also if there are different items of information or records that you should now start to keep as a charity in order to help you meet your reporting obligations that are coming up next year. And in terms of thinking about the people that use your annual report and accounts, think also maybe about including something in your next trustee's annual report about the fact that changes are coming, and that means that your accounts might look a little bit different in 2026, just to help prepare people for the fact that things are likely to look a bit different, feel a bit different, and what might that mean for them and what they start to need from you as well. Above all, I would say, please keep up to date with everything that's happening around the SORP consultation process. Visit the Charities SORP website. The web address is at the bottom of the slide there. And for all other bits and pieces that are going on in terms of legislative change in Scotland for Scottish charities later this year, please keep an eye on the OSCR website as well. There's links there to our social media bits and pieces as well. I'm sorry, Kelly, I think I've eaten into a whole 2 minutes perhaps of your time, and I do apologise. But without further ado, I'm going to hand over to Kelly now. Thank you very much.
That's great. Thank you very much, Laura. No problem at all. I'll try and keep to time from here on in. So good morning, everybody. Thank you also, Keith, for the introduction. I'm delighted to be here. And I'm just going to look at over the next kind of 20 minutes or so, just into a little bit more of the detail and the technical aspects of the changes to FRS 102 and what might appear in the SORP as well. So as Laura explained, as it stands, we've got FRS 102 at the moment, which is set in stone, basically, and we've just heard about the work that's going on by the SORP Working Party in terms of updating some of the SORP to help interpret FRS 102 for the sector. I think what's important though is that in the interim periods, and certainly prior to the consultation coming out and through the summer as well, I think it is important that charities are proactive in thinking about how the key changes to some of these areas will impact them, and also thinking about what work they could be doing in the interim. Really, we do know that we need some of the guidance that's in the SORP to interpret some of the key changes in leases and in revenue, as Laura has touched on. But I think having a think about what's in FRS 102 and any information that's out there already will really help you understand the impact more, and hopefully will help you to minimise the time, the costs and the compliance risks in the long term. Because if you do think you're going to have any complications, as Laura put it, I think there's some weird and wonderful arrangements out there and some of the charities that we all work with, then you'll have some time to sort out any issues that you're going to have as well. So I've set out the contents on the page, pretty high level there. So we'll touch on, first of all, the changes to FRS 102 very briefly, because I think Laura's covered that off. We'll dig into lease accounting and revenue accounting, trying to offer some practical tips for you all to think about in the interim periods, and then I'll just summarise with some general considerations there as well. So in terms of the FRS 102 changes, I'm not going to spend too long on the slides because there is a lot to get through. Fundamentally, as Laura has mentioned, it's periods commencing on or after 1st of January 26. So the first year end that's going to impact is going to be December 26 year ends. I think possibly for most people on the call, it will be your March 27 year end that is applicable to. So sounds like you've got a lot of time, but a lot to think about in the interim. So we'll just spend some time now going through lease and revenue accounting. So first up, lease accounting. So as Laura mentioned, the requirements have changed significantly. We've got what we call now a single lease model, which does require all leases to be recognised on the balance sheet unless they meet any of the exemptions that's in FRS 102. We'll touch on them in a second. So basically, as a lessee, you would recognise what we call a right of use asset on the balance sheet and a lease liability. And it's the lease liability that forms the basis of the initial recognition of the right of use asset, and it's measured at the present value of the lease payments. Now, this must be discounted at the interest rate that's implicit in the lease, or if this is not readily determinable, the incremental borrowing or lessee's obtainable borrowing rate is used. FRS 102 in section 20 does confirm that public benefit entities, so organisations like yourselves, charities, can choose to replace the lessee's obtainable borrowing rate with a rate of interest otherwise obtainable on their deposits that are held with financial institutions when you are initially recognising a lease. So it has clarified the interest rate that should be used. And just in terms of when you do transition to FRS 102 for the first time, in terms of that approach, the transition approach for leases is retrospective, but it's a little bit different to recognising a full prior period adjustment, whereby the cumulative effect of applying the amendments are shown as an adjustment to reserves at the date of initial application. So rather than having all the usual disclosures that you have when you have a change in accounting policy and a prior period adjustment and the effect on the prior years, it's all about the effect on the profit and loss of the current period that you're applying the revisions to, rather than restating all your comparative information. So I think that's a welcome approach. Just moving on, I mentioned exemptions. So just to touch on these briefly, there are two exemptions. There's low value assets and there's short-term leases. So low value assets, as the name might suggest, is whereby assets are of a low value. Now, the approach that FRS 102 is taken with this is to have a list included of assets that are not low value assets. Put them up on the slide. We won't go through those today due to time, but I think what that therefore means is that because there isn't a list of assets that do meet the definition, then I guess it gives preparers of charity accounts a little bit of flexibility in terms of determining whether or not you have assets that are of low value. And I would hope that the SORP might provide some guidance in this area as well. In terms of the short-term assets, that's about leases that have a term of less than 12 months. So if you do take any of these exemptions, then there is a bit of additional disclosure required in your financial statement. So you do need to disclose the fact that you've taken the exemptions, and there is required disclosure, a bit like an operating lease note that you would have just now in terms of the commitments that you have under leases that are of low value and short-term leases as well. So a little bit of extra disclosure around that if you do take some of the exemptions. If we think about some of the potential impacts, well, the effect on the statement of financial activities on your income and expenditure is to remove the rental charge, the cost that you would have in relation to an operating lease, and that is replaced with the amortisation of the right of use asset that you've recognised on the balance sheet, and an interest expense on the lease liability coming through as an expense as well. Now, over the life of a lease, the impact on the bottom line will ultimately be the same. The change in accounting does change the timing of the expense a little, whereby you'll probably find that the expense is a bit more front-loaded in earlier parts of your lease as opposed to the tail end of the lease as well. So there is a bit of a change there. In relation to the balance sheets, obviously you will see, if you do have to recognise any leases on your balance sheet, you'll have an increase in your assets and your liabilities on the balance sheet as well. So I think just given these changes that I've just mentioned, it is really important that if you think any of the figures that are going to change impact any of the monitoring that you undertake as a charity or a charity trustee in terms of any key ratios or performance measures, or indeed if there are any third parties that require you to monitor any of these, for example, if you've got any loans with covenants, or if any of your grant givers, your funders do require any kind of reporting on any of these areas, then it is important to start to think about what the impacts could be on those areas and perhaps have idly discussions with third parties as well. It is worth noting that there are a lot of enhanced disclosures in relation to leases as well. Again, I don't have time to go through them. I've got a huge list in front of me here on my notes, kind of about maybe 12 to 15 extra bits of disclosure. So the key there is just understanding what that disclosure is so that you can prepare that for your first set of financial statements. And then finally, just before I move on, I guess one of the unintended consequences of the change to lease accounting is the impact that it could have on preparers of accounts that prepare receipts and payments accounts currently, and also on any charities that are maybe sitting below the audit threshold and just below the audit threshold there. So at the moment, a non-company charity that has income of less than 250k can prepare or has the option to prepare their accounts on a receipts and payments basis. Obviously, if you have more assets going on the balance sheet and then amortization income coming in, there is a risk that your income is going to go up. So you will need to monitor whether you think that will impact that threshold. But I think more of a concern is the audit threshold impact as well, because although there is an income element to that, and that's income over 500k is where you have to have an audit, it could also be impacted. But I think more significantly, if you're a charity that leases a lot of assets or has big property asset, property lease rather, there is also a risk that you could breach the gross assets limit of 3.26 million as well. So if you think you're one of those charities, definitely worth having a think about that sooner rather than later in terms of whether you might require an audit after making these changes as well. In terms of specific challenges for charities, I think Laura's alluded to this already, and we'll say it again, we do expect there to be some, I guess, weird and wonderful arrangements in place in charities. But one of the key things that we see a lot in the sector is leases at below market rents. And we do think that this is potentially going to be one of the key challenges for charities. As Laura has already alluded to, the new section in the SORP is going to try and, explain this for the sector and give examples, etc. So hopefully that's really helpful. Some of the issues in relation to this is just in relation to where you do have a lease, where the lease payments are significantly below market rent. So in cases like this, it is possible that the lessee is providing, the lessor rather, is providing the lessee with incoming resources from a non-exchange transaction. And that represents the difference between what a market rent would be and what the rent is that the charity is paying. However, we do also recognise that there can be some circumstances where, although the rent is low, that might reflect the market value of the property such that there isn't a non-exchange transaction there. So, for example, it might be that as a charity, you're renting a property that's not in a great condition, that you need to spend some money on, and so therefore the rent does reflect, what the market value is. And I guess that might be the case for some of you who maybe lease community halls or heritage assets, or any kind of old buildings that have maybe kind of fallen out of use as well. So that's definitely something to think about, is that working out whether you have a non-exchange transaction in a lease or not. Now, if you do have a non-exchange transaction under the new standard, you would obviously recognise an asset for that. In terms of the incoming resources from such a transaction, they are recognised, first of all, as a cost to the asset, and then obviously you would need to recognise that through the statement of financial activities as well. And it's likely that you would refer to section 34 of FRS 102, which is the incoming resources from non-exchange transactions section in the specialised activities module of FRS 102, to look at how you would recognise the income. I think we're hoping for the SORP to provide a little bit of guidance on this, because it isn't abundantly clear whether you would recognise that all in initial recognition of the lease, or whether you would defer that and release it over the life of the asset, which would seem the sensible thing to do. But hoping that the SORP provides a bit of guidance on that. I guess another one of the challenges is, if you do have a lease with a non-exchange transaction, is how do you measure the market rent? And the expectation is that perhaps some of the smaller charities on the call might not have the resources to be able to do that, so could end up being costly. Might you need to obtain a formal valuation or involve someone else to help you with that? So that's one consideration as well. And also just linking into, again, that section 34 of FRS 102, whereby how does the impracticability elements of that section kind of coincide with the leases, because section 34 does seem to imply that you should be able, it's almost a rebuttable presumption that you should be able to value office accommodation or facilities that are given to you to either use freely or to use for a really low rent. So in one sense, we're saying you should be able to do that, or FRS 102 is saying that rather, but we know that in practice a lot of the leases and the assets that charities have in place aren't capable of being reliably measured, for example, using the example of a heritage asset as well. So it's just getting a little bit of consistency, hopefully, through the SORP as to what the approach to that would be. Now, Section 20 on leases does note that you might have cases where a lease doesn't meet or doesn't meet the actual definition in Section 20 because the rent is so low. So I guess, knowing that that's the case, you need to determine whether you think your leases meet that definition or not, and then kind of take it from there. I think what's key really is that we are awaiting, obviously the publication of the SORP to really provide further guidance in this potentially challenging area. In the meantime, though, in terms of some key actions I've set out there on the slide under kind of 5 key headings, I mean, really it's reiterating, a bit of what Laura has said there in terms of understanding what the requirements are. So reading FRS 102 Section 20, making sure that you do understand the requirements, seeking out any additional resources that might be there. I know from kind of preparing for this session, there's a lot, out there in terms of from audit firms like yourselves, other audit firms, ICAS, etc. So just make sure you're reading up as much as you can and making sure you understand initially what the requirements are. It is definitely worth looking at your current lease arrangements, so those that that are leases and those arrangements that could potentially be leases that you might not actually think meet the definition of leases. So it's definitely worth considering all of that and documenting any of the key elements, thinking about what records you need to have in place both now and going forward to allow you to account for these properly. The third step would be to think about whether any of your leases qualify for any of the exemptions that I mentioned. And then step 4 would be actually thinking about the numbers and what would need to come through the financial statements, and importantly recognising if you do have any of the non-exchange transactions in there that will impact income as well. Finally, it's thinking about any of those impacts on ratios in terms of your performance monitoring internally, covenants, etc. And I have put seek advice down there, and I think I put that in Section 5, but actually it's really important that if you do think you've got any funny arrangements that you are discussing that with your advisors and seeking formal advice if you need to as early on as possible. Moving on to revenue then. So again, as Laura has explained, there is a new 5-step model that's come in place in FRS 102 in terms of revenue, and it is based on identifying the goods and services that are promised to a customer and the amount of consideration to which you as an organisation is entitled to in exchange. So charities definitely do have to have a think about the different income streams that they have. I guess the key, before I touch on transition approach, the key potential impact here ultimately is timing of recognition. So it could be that income is recognised earlier or later. So fundamentally that could have a huge impact on your income and expenditure, and also on your trustees' annual report in terms of how you explain how that's operating as well. So in terms of transition, it's a slightly different approach here to lease accounting, whereby you do actually have a choice as to whether you apply the new requirements on a fully retrospective basis, rather, or whether you apply it retrospectively with the cumulative effect of initially applying the amendments as an adjustment to reserves at the date of initial application. If you do choose the latter option, rather than, again, the usual disclosures that are required when you change an accounting policy with the effect on prior periods, etc., the requirement is to disclose the effect on the profit and loss for the current period, rather than focusing on prior periods. And even under the fully retrospective approach, it is still only the effect of the adjustments for the immediate prior period that must be disclosed. So it's less disclosure required than would be, I guess, normal under a full prior period adjustment as we know it. In terms of the key considerations for charities, mentioned already and Laura's mentioned, there's going to be so many different income streams that charities have, that really the impact on you is simply going to be down to the types of income streams that you have, and fundamentally probably the contracts that you have in place to provide goods or services. I think this change is more likely to impact possibly legacies, legacy income, and also any grant or contract income that you have as well. If we think about some of the other income streams that charities have, so I'm thinking about the voluntary aspects, so donation income, fundraising income, I don't think these sources will be impacted significantly, or if at all, because if you think about it, they are recognised normally when they are received, because that entitlement isn't there until the money's actually changed hands. So I don't really see much change there. If we touch on each of legacies and grants and contracts then, so from a legacy point of view, we know that this is a complex area already for charities, and previously in the old FRS 102, there was an appendix to section 34 that dealt with legacies specifically. So that appendix has actually now been completely removed, and most of the elements of that have been included within the body of section 34. But what we have noticed is that the clarification wording on when a legacy receipt is probable has been removed from that section as well. So I guess what that suggests is that the SORP is probably going to be, or hopefully going to be, given a bit more guidance in relation to that probable element of legacy income. Similarly, they have added a new paragraph to section 34, and again what we've noticed is that it's missing the criteria in relation to when entitlement occurs for a legacy. So previously FRS 102 did actually specifically reference that probate is a likely indicator of entitlement being met, and that's now not there. So again, it's waiting for the Charities SORP to maybe clarify some of these areas around legacy recognition. In terms of grants and contracts, my personal view is this is probably one of the key areas from a revenue perspective for charities, and unfortunately, as you might have expected me to say, we don't have all the answers at this point in time. We know that there are going to be so many different agreements out there with funders, local authorities, etc. Some with performance conditions, some without. We just don't have the time to kind of go through each one of those. But I guess it is likely that there could be changes in some of these areas. The other area where we anticipate perhaps some changes, things like membership packages as well. So there's a new term within FRS 102 that's called unbundling within this revenue standard. So whereby there might be different elements of income that's recognised at different times, and I think membership packages probably fits the bill in relation to that. So I guess really just waiting on the SORP to clarify some of these areas for charities as well. As an aside, there's also been some update to section 34 in relation to income from non-exchange transactions. I've mentioned that obviously as part of the leases section, but there are other areas in there. It's actually been updated, and some of those areas are quite helpful in terms of how you treat kind of assets that have been donated for resale and volunteer time, etc. So I do urge you to have a read through those. And then just similarly for the leases, I have set out just some of the key actions. I guess there's a little bit of repetition here because fundamentally the initial stage is about reading what's in FRS 102, understanding what the requirements are, looking for any other information that you might have out there to make sure that you understand that. In terms of your current contracts and your income streams, I would suggest that you understand what those are, document them, look through all the contracts and the records that you have in terms of the specific terms and conditions, noting down how you currently account for them, and then thinking about any, I use the term unusual arrangements. So anything that might have, I don't know, multiple services in one contract, or anything you might need to unbundle. Is there any contracts where there's any variations within the contracts, or are there any elements of contracts that are maybe subject to negotiation? These are the types of things that you want to be looking out for. Step 4 then is looking at the numbers again, thinking about what the potential impact could be. to the best of your ability, I guess, before SORP's out. And finally, just considering any impact, maybe chatting to any third parties that may be relevant here. And I'm thinking possibly funders and grant givers as well at this point. Okay, so I'm conscious I want to leave a bit of time for questions there, because I'm sure you've got some. So just in terms of those general considerations, just wrapping up really, I think what Laura said in terms of preparation, and also what I've just tried to advise you, over the last 20 minutes or so, is, I think the key message is, yes, we're waiting on the SORP and it's hotly anticipated, but I think in the meantime there's definitely things that you can be doing, looking at the revenue and the leases side of things, just in terms of getting a little bit of a head start on the preparations. And I think that's the key message that we wanted to get across from this webinar today. So, read what's out there, attend webinars, etc. Understand what you have, I think, is one of the kind of key points, making sure there's no impact on the audit threshold if that impacts you as well. I think what the sector's really good at is speaking to each other, so making sure that, if there's someone in your network, that you're collaborating with them if you've got the same issue, etc. So just making sure that we're doing that, looking out for the SORP consultation, and then just thinking about, and particularly if there's any funders and grant givers on the call on the webinar today as well, as you need to understand the impacts and what the requirements are, because some charities accounts are going to change significantly, and what we don't want the default to be is that, oh no, there's something wrong, they've made a mistake. There needs to be an understanding that there's a big changes in accounting coming here that might impact some of the things you see in charity sets of accounts. So fundamentally, start preparing now. Yep, thank you, and happy to take any questions. I think we're going to pass back to Keith, who will look to see whether there's any questions from anybody.
Thank you very much, Kelly, and also Laura, of course, before that. Just before we move on to the live Q&A section, and yeah, we do have a number of questions coming through. It would be great if you could leave us a rating for today's webinar, and there'll be a poll appearing on your screens now or in the chat box. There it goes. And we really appreciate your feedback, so if you could just take a few seconds to respond to that. We will now just pick up on the live Q&A. If you want to add in a few more, then that will be great. But yeah, we've got Laura and Kelly here. First, not surprisingly, Kelly and Laura, quite a lot on leases. I suppose the very first question was about, will this apply to a regular lease of our charity office?
Yeah, I'll take that one, Keith. So yeah, I mean, yes, any leases fall within the definition. So if you do currently have an operating lease for your office, then yes, you would need to have a look at that. Yeah. And that would be on balance sheet. Yeah.
Okay. And there was a bit of a follow-up about how do you then consider break points in leases. If you've got a 20-year lease, but maybe a 5-year lesser only break point, for example.
Yeah, so I'm going to be open and honest in terms of not knowing the exact detail of how you deal with breaks at this point in time. I do know that FRS 102 does kind of cover breaks in terms of how you would measure that. So maybe that's one we could confirm after the session, if that's all right.
I was actually going to say it's particularly relevant.
You've done a lot on that, Laura.
Yeah, I've thought about that a lot. It's particularly relevant where you're trying to then work out what the actual lease term is, and that's then very important for you to be able to actually measure your lease liability. So it's not so much how is it dealt with, but where is it relevant? That's where it's relevant as to what your lease term actually is.
Okay. That's fine. Just a more technical, we've got one question from people with thinking from an R&P accounts, receipts and payments accounts, which don't have a specific balance sheet. How does the leases perspective need to be included in these statements? I know this is fairly technical, but maybe just a high-level response.
One of the things I would say is that on a statement of balances within a set of receipts and payments accounts, what you're really trying to do is you're trying to give the user of your accounts a good understanding about the commitments, for instance, that your charity has and what assets and what facilities or what resources it has at its disposal. So while the requirements that we're talking about here today about leases are not directly relevant to exactly what you have to show in your R&P accounts, what the statement of balances should show or give in a narrative form is a good understanding of what have you got at your disposal. So if you've got the right to use an asset, a building, for instance, explain that on the statement of balances. If you've got some information about the value of that and indeed the liability that's required over the term of that arrangement, again, I would say disclose and explain that on your statement of balances.
Okay. Thank you. And just looking at time, we've probably just got time to pick up one more. So moving off the leases and into just what you touched on about revenue in the presentations. It's looking, I suppose, for a bit of guidance around what are customers in revenue. Does that include, for example, funders or donors where you might have a multi-year grant funding arrangement or something?
Yes. Is the simple answer. Yeah, so I'm sorry if that kind of didn't come across in the presentation, but yeah, absolutely, we would expect these funders and donors to be classified as customers for FRS 102, and multi-year agreements is going to be one of those complexities as well that's brought into it. Laura, I don't know if you'd add anything to that.
No, nothing particular, but yes, it would include that certainly, and that's part of why in developing the SORP and looking at the 5-step model in particular, we're trying to provide as much support and guidance about each of the steps so that charities can really identify where they sit in the steps and how they work their way through them.
Okay. So I'm very conscious of time, and the one thing that was on my to-do list today or my reporting was to get us through in time. So we've got a number of other questions that I know have come through. There was a few other bits put in the chat. We will compile a Q&A document covering any key unanswered questions as part of just debriefing from this, and we'll upload that alongside the recording of the webinar, which will be at icas.com. /webinars. So please remember, you can keep up to date with all the latest professional news, including information, guides and resources on icas.com. Looking ahead, there's a range of webinars and events in the weeks ahead, which you might also wish to sign up for. A couple of online events, 25th of February, which is covering navigating careers with support on mentorship, wellbeing and professional growth. And then on the 11th of March, latest developments, changes in the VAT space. And then there's a couple of in-person events, the Accelerate Action for Women, Planning for Financial Security, and that's 26th of February in Edinburgh and 27th of February in London. And of course, we touched at the beginning, in March we'll be opening up bookings for the SORP 2026 webinar on the 22nd of May, which will be during the consultation period that's been touched on. So look forward to welcoming you all back at that point. The links to sign up to all the ICAS events are at icas.com, news and insights events for the upcoming events. So just in closing, I'm sure on your behalf, you would like me to thank Laura and Kelly once again for their excellent presentations and all the insights they've provided for you. And we thank you collectively as the audience for joining the webinar today. We hope that it has been very helpful to you at this starting point in preparing for the changes. So until next time, goodbye.